is where the rulebook ends and the real brand talk begins. Welcome to On Brand. Welcome to Off Script.
It's a tough one, that industry, because
It's a very
the
tough
reality is, yes, there are people who afford like local fashion, but for them, it's got to be relevant, it's got to be good quality. And then if you start talking all of that, then the production cost, and if it's got to be produced in Botswana, then the cost of producing in Botswana is more than it's going to be in Mozambique, for instance, for sure.
But
Yeah.
then I think then the core, what they're trying to do is what I appreciate, because it's built around masterclasses to empower local artists, whether it's fashion designers or people who produce something around fashion or models. And that was the concept.
I think what more may happen is actually some of these guys will get inspired and go into these other markets and become successful there. Not necessarily be successful here, but be successful there and then bring something small back home to say, no, this is... I see that with so many, like, especially in these creative kind of fields, because Botswana is too small a market for them.
It's tiny.
Yeah.
And I think just branching off of that, because I felt that event was very similar to where I met you,
Right.
which was the World Series. And shout out to Series Capital and Buemo and his team, because they set up a platform where people could come and eventually around funding. And they had invited you and a couple of people to come and at least guide people, be part of the judging panel, and then also be a platform that funding is possible in that space, and also just educating those who had come to be in that space to say, what is venture capitalism? What is early stage funding? How do you then guide around pitching and pitch decks and so forth? And I think that is so critical because a lot of people don't understand the early funding ecosystem, especially in Botswana, because it's in its infancy compared to other markets.
Absolutely in its infancy. I completely agree with you. I think the other thing is, you go into some of these other markets in Africa and you see a person pitching, and you're like, wow, what an incredible pitch. But the reality is they've probably done 100 pitches before they came to see you, right? And that's not the case in Botswana. In Botswana, a lot of these companies may be sometimes their first or second pitch they've ever done in their lives. And so suddenly what you're seeing is something that's a little rough around the edges, right? So I think events like that we met at, I think definitely they're good events. They get people out on the stage. There's a time limit for what they have to be able to present in. And you saw it, right? Some of those companies were far superior in their experience of pitching compared to some of the others.
Definitely there's a difference. And also it speaks then to the context in Botswana, because we want to reference that lens. How would you describe the ecosystem, the early stage funding ecosystem in Botswana? Where are we? Where should people play? What is your thoughts around that?
Yeah, I mean, it's an interesting one. I think obviously the last 18 months has changed it dramatically, right? I would say post-COVID, or like just, during that COVID time, 2020 going forward, a lot of the funding was very government oriented, right? And was all competitions, right? So a lot of the, let's say, corporate / funds, these CSR funds that had like these pitch competitions, and you could win 5,000, 10,000, 500,000, right? So, and then you had government debt funding bodies, right? So SIDA, LEA, or you could get into an incubator or an accelerator, like what, BDIH has one. Stanbic tried to provide this kind of space, right? And all of that is, in some ways, is funding. Because even providing space is a form of funding, right? Because rent costs money. And so I think what's changed, since those pre-COVID periods to just around the COVID period was there's now a lot more kind of private money that's also starting to try and get into that ecosystem. And I think it's normal, right? I mean, Botswana is only 60 years old this year, right? And so we're still relatively young. From a private economy perspective, the number of private sector players who would have a bit of discretionary capital that they are not using to build a house or buy a car or, go on holiday is also increasing now, right? The numbers who have that little bit of extra money who say, okay, I want to invest this money, and instead of putting it into a bond or shares, listed shares or something that's more secure, a fixed deposit, some of them will start having a little bit of extra capital that they can start saying, okay, I'm willing to put this at risk, risk capital. So I think that really the trend started from 2021, kind of there. And that's when the Angel Network was first formed, right? So there was this, I'm trying to remember what event was, but there was a government-led event where they brought out, the founder of ABAN, which is the African Business Angels Network, a great gentleman. And he came out here, he spoke to a whole bunch of business people, right? And high-ranking corporates, right? Who have that kind of additional risk capital that they can place into early stage startups, and started talking about the concept of angel investing. And to be honest, it's exciting, because even for somebody like me, while I have been doing angel investing, let's say, for a while, the professional angel network makes it so much more exciting. Because otherwise the investments I'm going into as people that I know. So it's almost like a friends and family kind of funding, more than a professional angel kind of funding. So, listening to pitches, getting these startups. So I think it's evolving. What I will say is, even with angels or those who want to be angels, there's a huge educational process, right? People have to understand that vast majority of businesses you invest into at the angel stage are not going to succeed. And that's been the case with me. There's 2 businesses that I've invested into. I've written down the value down to 0. One is completely closed and one is dormant, right? And if I go and say this to somebody else outside, they're going to be like, you're just throwing your money away. But the reality, there's another business where the business has grown by 20x already, right? And there's another tech-based business which, to be honest, it could be 100, 200x business. And these are Botswana-based businesses, right?
So there's definitely a gap when it comes to the education, the understanding in terms of where you play when you come into this, how to present yourself,
100%.
how to pitch. So maybe let's get into that in terms of somebody who wants to get funding. And you want to create a pitch. What do you have to understand, or what do you need to know? How do you set up your pitch? If we can just maybe guide on what somebody needs to prepare to do the pitch decks.
I think, from my experience of listening to a lot of pitches, the successful pitches are able to convey the message of what they're trying to solve very clearly. They're able to show why they are the right people to be able to try and solve that problem. They have very clear metrics on what would be success in their business, right? And the reality is they have the ability to project all of that clearly, right? Because you'll meet founders who've got the right idea, who have the skills to be able to execute. They may even have a good team behind them. They may understand their numbers, right? Numbers, financials makes a lot of sense. If you don't know your financials, no investor is going to put money into you. You have to remember, this is hard-earned money, right? That they could be using on a holiday or so their own personal luxury, but they've decided to potentially invest into your own business, right? But then they just don't have the words to be able to articulate what it is, or they have an attitude issue. And this is the other issue I've seen in Botswana, and I see it's changing, but it's almost the attitude of, I deserve this money.
Like entitlement.
You must give me this money, right? You have it, I must get it. And the reality is, yes, that's why the angels are putting themselves out there to say, come pitch to us. But at the same time, nobody wants to feel as if they're doing you a favor by giving them giving you money. Right? It's the other way around, right? They're investing into you.
Exactly.
Right? You being given that gift of that investment, and you've got to take that investment. And with angels, it's different. It's not just money, right? The amount of time of mine that I give to the companies that I've invested into, I'm willing to give. Let me put it that way as well. Okay. And maybe we'll get to that. I also want to talk about post-investment and the second round of investment at a later stage. But I think these are the main kind of characteristics I think I want to chat about. If somebody's coming to any investor, let alone an angel investor, even their mom and dad, right? Nobody's going to put money into it unless there's a real business, right? I think smaller things are, what's the competition out there? How easy is it to replicate what you're trying to do, right? How far have you gone with your business? Are you still an idea, right? Or have you got a product? Have you started earning revenue? So, and at each of those stages, right? So whether it's ideation, minimum viable product, or post-revenue, pre-revenue, post-revenue, right? At each of those stages, there's different types of investors.
Yeah.
Right? At an idea stage, if you're lucky, family and friends. If you're very lucky, maybe an incubator or BDIH kind of environment will support you, right? To take you from ideation to at least having a minimum viable product, right? A prototype. And then when you go from prototyping to the next stage, you kind of, there's where a lot of these accelerators, incubators kind of play a little bit of space because they can see, okay, you've got a real idea, you've got a product that is sellable, there is a market out there, but you need to be able to get from there to having your first sale.
Yeah.
Once you started having a sale is where an angel can step in, right? It's that, and the reality is that's where many businesses fail because you've already burnt through all that initial money. They call it the valley of death. It's a terrible term, but that's the reality. And it's that valley of death stage that actually angels kind of step in to assist because in most environments, and we'll come to what comes next in Botswana, because I think that sometimes doesn't exist, right? And in that valley of death phase, you need more than just money. You need network, right? You need the ability to take this product out to many people. And let's be honest, Botswana is a small economy. People kind of know each other. So if somebody who's known, who is successful in business or a corporate goes to somebody else, like if you went and recommended somebody's product saying, hey, listen, I've tried this person's soap.
Yes.
It's fantastic. You guys should try it too. There's a higher chance that person will say, all right, I'll try it out. Then if somebody who's unfortunately is not known, right, comes to you and says, you know, I'm making soaps. Will you try my product? They're going to be like, oh, all right. But, you know, I can buy a product at a supermarket, you know, as well. Why should I buy your product?
Yeah.
You get what I mean? And I think that's the other big thing, the network part. And the third is the mentorship part. And I think we can't put enough emphasis on the mentorship part. Right? Mentorship is needed, I think, throughout. I mean, I've been in business for almost 20 years. I still need mentorship, right? It's never gonna, you're never gonna not have mentorship in your life. But at that valley of death phase, I've seen these two businesses I was talking about.
Yes.
The problem with them was they didn't ask for the mentorship, right? They shifted, they took a pivot in their business because they thought that was the right step.
Yeah.
Unfortunately, both those steps led to loss of reputation in one, and thus their business completely disappeared. Like a successful business. The guy was cash flowing, making profit, and completely disappeared because he lost trust of his customers.
Yes.
And the second one, because they had a business that was at least giving them some revenue while they were using that money to develop a tech system. And then they stopped this because they focused solely on the tech system. But the tech system doesn't give you any revenue yet, right? Until you start using it to create some money. And they wanted to rapidly get to a stage where they could start earning money. But when they got to that stage, they suddenly were at the last mile and they ran out of money, right?
Yes.
And so you have, you know, I think mistakes that were made by these founders that if they had used these angel investors or the investors that were in their business as an advisory board, as a mentorship structure for networks, they could have avoided these mistakes because a lot of these mistakes are the same, you know, like business people, mistakes or the problems we face are sometimes actually quite similar.
Yeah.
Somebody's been through it already.
Yeah.
Somebody's got a solution. If you ask, somebody's going to give it to you, right?
And I think then from the founder perspective, they underestimate the amount of time that it takes to get into a partnership like this. From the mentorship perspective, I think you've highlighted something that I didn't even consider in terms of the capacity that you need to have. Yeah, you're putting in more than just a monetary investment. There's time and there's advisory and networks and so forth. But then it got me thinking then, do investors then also underestimate the amount of capacity and investment beyond monetary that they need to put in? So if I was to want to step into this area of investing, what do I need to prepare? How much capacity do I need?
You know, I almost say it's a 1-to-1 ratio. Like if for every pula you invest, that's how much time or effort value that you've got to put behind it as well. Because we're not a mature ecosystem, right? and we're working with relatively younger founders, right? To be honest, one of these founders was not young. They were a successful corporate, had run a business for a while, and then decided to go into the tech scene, right? So you would have expected more, right? But the other person was a young, had graduated a few years ago, had come up with this idea, had a team of people who they'd been working with, I think, since university. That's the general founder in Botswana, right?
There's a very little experience that they're coming in with.
Absolutely.
Yeah.
And if you go into other markets, you go to South Africa and I was 2 weeks ago, I was in Cape Town for an immersion week for a Africa-based VC fund, right? And they had 10 of their startups that they had invested into, early stage businesses they invested into. You go and talk to them. The first thing these founders are talking about is not about the business that they like talking about. This is the team, and these are all the places these teams have worked. And it's all the big names globally. Right, exactly. And so then you're suddenly like, okay, these guys are legit. They've got the skills, they've got the, let's say, the backing for what they're trying to do. Okay. You already start feeling warm towards them, right? Now, if you take somebody who's just come out of university and says, I'm a 20-something young man or woman, and this is my idea, this is the problem I'm trying to solve, it takes a little bit more. I'm not saying it's not possible. I think it's actually very possible, because I think the youth sometimes are closer to the problems than people who are very well experienced, right? They've maybe faced those problems themselves, right? But yeah, I think for investors, especially in Botswana, we have to know we're a nascent ecosystem. We're going to be working with young founders, inexperienced founders. We've got to be able to give more than just money. And sometimes what happens is, even before you give money, you have to give your time. And one of these businesses was exactly that. There was a pitch day. She pitched her product. It was a soap company, a cosmetics brand. And she pitched her company. And to be honest, at that stage, she was not pitch ready. But she had core knowledge and she had passion.
Yes.
And you can read that from a founder, right? She knew her product. And the reality is, at that time, it was still a side hustle. So here's the other thing. No investor is going to invest into a side hustle. So if you've got a corporate job and you're trying to run a business on the side, well, it's a business on the side, it's not your business, right? So, and this is always my thing, is that if you want hard-earned money, you have to be able to commit to your own business. You've got to be able to live your own dream, right? And your own vision. And so we actually spent, as a group of about 2-3 of us, we mentored this founder for about 12 to 18 months, transitioned her out of this being a side hustle to this being a real business, gave her lots of experience about what pitching is all about, what are people looking for, got her financial system kind of working and in order. It was a lot of, her own bank account was what was being used by the business. One of the first principles I ever got taught is the business and you are two totally separate people, right? What the business earns is what is the business's. What the business gives you as a salary or as a dividend, that's yours, right? They're not the same. They cannot operate the same.
And I think a lot of times with entrepreneurs, you merge into the two entities into one.
Exactly.
And just on that point that you had, because that's a lot of time to invest into somebody, 18 months. And I'm assuming at that point, money is not coming in yet. And so as a founder then, what are you evaluating? Because this person came in with an idea and you can see that there's this huge gap between where they could be. There's a huge gap for you, a risk for you also as well, because you're putting in money and time. So what does that evaluation process look like?
I think that's the difference between an angel investor and a traditional VC investor. An angel investor is willing to put in that additional amount of effort because you have a certain kind of drive towards supporting the development of the ecosystem, right? While a traditional VC fund wants an ecosystem that's producing something for that. When we know there isn't an ecosystem, right? Or there is a very nascent ecosystem. It's not that there's no ecosystem. I should take that back. But it's let's just say an ecosystem that is at a very early stage. You have to be an ecosystem builder, right? Angel investors are ecosystem builders, right? They're not just trying to take the rewards from this one. I will also say from my personal perspective, I saw in her the passion and drive that's so important for me to invest into a founder. Right? As I said, the founder's got to believe in that business more than I should. Right? The founders, that energy's got to be so palatable in the air that it kind of drives me towards, in this case, her business, right?
Yeah.
And that 18 months of, meeting up, it was like once or twice a month for an hour, just talking about what is she doing and kind of laying out.
So
these
this
are the
is
next
structure your
steps.
setup.
It's a kind of,
a specific.
to be honest, I don't have a very documented, structured system. I'm being very honest. But I think it evolves because every founder is different. Every business is different, right? Sometimes you're going to be starting to talk about basics like what is your business model? What are your cost structures, right?
So you're customizing.
Yeah, exactly. And and you talk about the product, price, place, the typical business. Yeah, exactly. You know it even from the marketing world.
Yeah.
And sometimes it's about talking about that. It's not that the founders don't know it, right? Sometimes it's inside and you've got to document it, right? You've got to put it out on paper because the founder has so much going on in their brain, right? That there's people around them and they may not necessarily feel or know where this is going because it's all sitting inside.
I have the expertise and the knowledge to be able to advise.
Yeah.
Yeah.
And so that's what the mentorship part is. It's really about taking it's not about telling the founder what to do, because I think then the founder's not the founder, then you're the founder, right? In mentorship or in coaching, my approach has always been about, this is your business. My job here is to kind of enable you to bring out whatever you have already in about the business, but at the same time advising you on aspects you may not have thought of and getting you to think about it. And that's why sometimes it takes 6 months, right? I think normal mentorship is usually 3 to 6 months.
Yeah.
A business that I'm willing to invest into, I'm willing to take that up to 18 months because that additional 12 months actually gets that business to a stage where it's more investable, it's more successful, and the probability for it to be a high growth startup, which is the kind of place I'd like to invest into, increases.
Yeah.
Right? So good mentorship increases the speed at which a business will grow because you're kind of enabling that founder to do more, right? And I firmly believe this. I believe Botswana's founders have as much ability to be the next Flutterwave or Move or any of these other unicorns that have come across on the continent. It's possible. Yeah. Botswana provides a great sandbox. I always say this, right? I think because we're small, it provides a great place for people to iterate, and tinker with their product and see what is really going to work. What's the right price point, right? Because we have so much diversity in our population as well, right? You've got, we have a huge Gini coefficient.
Yeah.
And for many places, that's a negative, right? I mean, lots of people who've got lots and lots of people still are, have to get out of there, right? But what it does mean is that we also have a huge market, right? Or disparity or what do you call it? Diversity of market. And that diversity of market enables testing.
Yeah. So doesn't it limit it then in terms of, because we do inherently have a very small market, it's 2.2, 2.5, and makes it very difficult for you to then come in with very niche products. And I think as you're talking, one thought that came to me was then when the founder is then preparing or just mentally preparing, and also from the perspective of the investor or the angel investor, is then there an expectation or an understanding that I can only get so much? And in preparing my pitch, or at least how I should present myself, this is how I can position myself to say, I will need this amount of time from you, this amount of investment. I need to be able to communicate that or articulate that. And then also, isn't there a cutoff point from your perspective where you say, I can only do this much as a founder, because I'm trying to get
100%.
to where do investors get it wrong?
Yeah, no, and 100%. I think this is the other aspect. I wish all pitches could kind of portray as well as you did, right? That's the reality. The way funding works is it's not continual funding. Nobody will give you a pay slip, a salary every month. Somebody will come and say, okay, I've got 10,000 pula, I've got 50,000 pula, I've got 100,000 pula, depending on it, right? And that's my check size. And generally, the way angel investing works is they'll form something called a syndicate, right? I know syndicate has a very negative, dark meaning in the rest of the world, but the reality is what these syndicates are is a grouping of people who've come together to be able to make that ticket size. So say a founder needs 200,000 pula, right? To get from where they are right now to the next stage, okay? Usually it won't be one person putting in that 200,000, right? There'll probably be a lead investor who will put in minimum 50% of that, maybe a little bit more, and then everybody else kind of pockets in a little bit extra, right? And the reason that syndicate kind of forms is there's usually one investor who's really interested in the business, right? Who's, like, for instance, the business I was talking about, we spent a lot of time in it. We knew it. We were the lead investor. And a whole bunch of other investors kind of came on and coupled on based on our intrinsic knowledge of that business and the founder. Okay.
Which helps spread the risk.
Which helps spread the risk and allows you to invest into more. Remember what I told you is that vast majority of the businesses you invest into at this stage will never make it out, right? So if, say, out of 20 businesses you invest into, probably 10 to 12 will completely disappear. You'll lose your money. Probably 8 of them, or, say 6 to 8, you may make just about what you put in, you may get out, and 1 or 2 will hit the bank, right? And make enough returns that you're willing to come back and invest again. Right? That would be an ideal situation. In 10 years' time, if we had the same conversation, I'd love to say, I've taken all the money that I've invested into startups and I've put it into more startups, right? And that's where it is in a lot of, if you go to the US, that's what's happening, right? And sometimes these successful startups are the ones investing into startups. And that's the big thing, is that they invest once, right? They want you to get your business to a stage where it's sustainable, that it's growing. So there's different types of business models, right? You've got, I'm a real estate developer. So that's a very traditional brick and mortar business, right? Where you almost want to make a profit from the first project, okay? While if you go into the tech scene, many of these businesses have $1 billion valuations, but haven't made a profit yet. Okay. And it's just about where can they go? How big has their...
It's concept stage.
And how many customers have they acquired? How big a network have they created? And the potential for profit it has, right? So there are different business models. The reality is when an investor invests into Botswana, right? They are going to look at the business and say, which kind of model is it? Is this a traditional model where, you know what the cost of the product is, thus you know what you can sell it at, and that's the margin the business makes, and that margin has got to cover, your overheads and in financial costs, and then make a profit. And that's more a traditional kind of business model. And then the tech model we've already talked about, right? Just grow, right? Grow as fast as you can. 50, 60, 70% a year kind of stories. Between that first investment and the follow-on investment, a lot depends on the founder, right? Because when you make that first investment, the founder's making certain commitments to those people investing into their business, right? And there's different models, like they call them safe notes and revenue-based convertible notes. And there's so many different, models around investing into the business, right? And these are generally equity investments, right? They're not debt. Because debt burdens a company while equity kind of enables it, right? And I think it's a big change that's happening right now, even with government funding, where I'm told it's moving from a debt model to an equity funding. So I'm really excited about this. Okay.